Hello and welcome to the Taylor Trades Options channel. In this video, I want to share with you 7 key principles to help you become a more consistent and profitable trader. This can be applied to all types of trading and not just options. So, 7 principles of consistency. Number 1, I have objectively identified my edge or edges in the market. You have done your homework, and before you place a trade, you completely understand and have identified your edge in the market. You also have as much supporting evidence as possible to make sure that the trades that you do place are over long periods of time going to be winners. So whether that's through backtesting, theoretical edge, volatility, etc., there's lots of free content out there to help you find a way to make money in the market. I like to think of it as if this was my job and I had a boss that I had to explain everything that I do to, I want to make sure that my explanation and what I'm doing in the long run is going to be correct. So if I've got a whole string of losers, or each month my account is going down and down and down in money, well then I better have a good explanation as to why that is. Number 2, I completely accept the risk of this trade. Before you open a trade, you understand your risk and have managed that accordingly. Accept the worst can happen and will probably happen over the lifetime of your trading career. If you are consistent with your approach, at some point something will happen that will completely knock you off edge. There are black swan events all the time within the market. It's part of it. The market gives you the opportunity to make money, but it also has the opportunity to take money from you. Just remember that when you are placing trades. Number 3, I act on my edge or edges without reservation or hesitation. You have to think of your edge, so don't overthink it. You have your edge, don't overthink it. You want to be as unhuman as possible and you want to let the numbers play out. Ignore the mainstream news, ignore people on Twitter, ignore chat rooms. Once you've found your edge, block out all the noise and just focus on yourself. Number 4, it's important to have a daily routine. Most of us have kids and family and work, or live in a different time zone and may not have the luxury to trade from the open to close. It is important to go through a routine before you start trading. Just like a captain of a plane, before he takes off, he has his whole pre-check flight, things that he needs to go to. Now, for example, this could be once you're sitting down at your desk, you're checking futures, you're looking at what's going to be announced that day. If you're trading stocks, what stocks are going ex-dividend? Is there going to be an earnings announcement? Once you've got all that information, is this going to impact your trades for the day? Keep an eye out for market holidays, and then really once you've created all that knowledge, then you can look into your actual portfolio and go, right, okay, is there any winners that I need to close out? Is anything that needs to be adjusted? Check all your beta weighting or your direction of the portfolio. How much cash do I have? What positions are then going to be suitable? Placing trades, be patient once you do get your trades on, and then off you go. Principle number 5, I keep a trade log or journal. It's very important to keep a trade log or journal, simply because you can then go back and review what's been beating your expectations on your edge and what hasn't been quite up to the mark. I do this every quarter. I sit down, I go back through my trades to see what has worked and what hasn't worked. It's important to then take that and use that information to improve your style and your methodology. I also like to track my emotions before and during a trade and track why I entered that trade and then why I exited. One key point is never take any revenge trades. The most important thing to recover is your self-confidence and not money. Principle number 6, I continually monitor my susceptibility to making errors. Hey, listen, we're all human, we all make errors. Now, it is important to maybe keep a separate log of errors that you make, just to avoid repeating these in the future. Some errors can be completely detrimental and devastating to portfolios, so it's important to make sure that everything else is in the right place, and if we do make an error here and there, we understand what we did wrong and then we can move forward. If you're worried about making errors, or if you're worried about losing money to begin with, and you don't quite understand your platform, paper trade. It's easy to do paper trades. Learn how it works, buying and selling, shorting, going long, puts, calls, etc., etc. Can all be very confusing. Sometimes you're selling something and then you have to buy it back. It might take a little while. Get used to the mechanics. And finally, principle number 7. I understand the absolute necessity of these principles for consistent success, and therefore I never violate them. Remember, anything can happen in the market at any time. You do not need to know what is going to happen next to make money. There are many variables that define an edge, and an edge is nothing more than an indication of a probability of one thing happening over another. Every moment in the market is unique. And finally, predefine the risk to every trade. So there you have it, the 7 principles of consistency. Please feel free to comment below. If you have found this valuable, then please like and subscribe, and I'll hopefully see you in the next one.